Welcome, curious minds, to another deep dive. Today we're plunging into, well, a truly fascinating paradox. How does a powerful technique for understanding chaos, a method born, not in some quiet university office, but from a quest for something like nuclear power, miles away from high finance, how does that become absolutely vital in navigating the wild world of Forex? We're talking about Monte Carlo simulation. It's this tool that helps us understand and price and strategize in the, well, inherently uncertain world of currency trading. Our mission today is basically to shortcut you to being really well informed about Monte Carlo. We'll look at its unexpected origins, its core mechanics, its critical uses, and yeah, unearth some surprising facts along the way. Think of this as your guide to why Monte Carlo isn't some crystal ball, but more like a powerful lens for looking at risk and strategy. Okay, let's get into it. So let's kick things off right at the beginning. And it's almost certainly not where you'd expect. Monte Carlo wasn't born in a trading room, screens flashing everywhere. Oh no, its birth was much more secret, much more atomic. It came out of the secret physics labs of the Manhattan Project during World War II, invented back in the 1940s by the mathematician Stanislaw Ulam, who, funnily enough, apparently got the idea of playing solitaire while sick, and the physicist John von Neumann at Los Alamos.
Right. And what's really fascinating is the core idea that came out of that. Using repeated random sampling, basically, to solve problems that were just too complicated for standard deterministic math, their first use case. Modeling neutron diffusion in nuclear reactions. I mean, imagine trying to predict the path of one single neutron is completely random.
Impossible.
Exactly. But the aggregate behavior, what millions of neutrons do together, that turns out to be describable statistically. And that really highlights its power in systems with tons of random variables. It's about seeing the pattern in the chaos, even if each individual part is unpredictable.
And the name, Monte Carlo, I love that detail, coined by their colleague Nicholas Metropolis, right?
Yeah.
A nod to the famous casino. It perfectly captures that central role of randomness. A little wink, really.
A total wink. And from there, jumping into finance, well, that was quite a leap conceptually. It started pretty humbly with David B. Hertz's 1964 Harvard Business Review paper. He talked about using it in corporate finance. Yeah. But the really big moment, the one that truly brought it into our field, was, 1977. That's when Phelan Boyle published this hugely influential paper.
In the Journal of Financial Economics, wasn't it?
That's the one.
Yeah.
He showed how Monte Carlo could price complex derivatives that black skulls just couldn't handle, especially things like path-dependent options.
Like barrier options or Asian options, where the whole price path matters.
Exactly. Their value depends on the exchange rate's journey over time, not just where it ends up. Black skulls struggled with that complexity. Monte Carlo can tackle it.
Incredible journey from the atom to the option pricing desk. So, okay, let's talk Forex. Why do traditional single forecast models often fall short there? What makes Monte Carlo so suited to that kind of uncertainty?
Well, the Forex market is just inherently uncertain, isn't it?
Yeah.
You got things like market sentiment shifting on a dime, unexpected geopolitical events popping up, central banks making sudden moves. It creates this environment that's just packed with random variables. So those traditional models that give you one single best guess forecast, they often fail because they can't capture the whole range of what could happen.
Right. They give you a point, but reality is more like a cloud.
Precisely. What Monte Carlo does is model a range of possible outcomes, and importantly, their associated probabilities. It acknowledges that, okay, maybe one single trade's outcome is super uncertain, but the performance of a strategy over, say, hundreds or thousands of trades, that can often be described by a probability distribution. It's really just like that neutron problem again. One neutron, random path, millions of neutrons. You get a statistical pattern.
So if it's not predicting the future, what is its main job in Forex? How should we really frame it?
It's fundamentally a tool for exploring possibilities, a risk analysis and system exploration tool. It helps you understand the potential universe of outcomes. And that name, Monte Carlo, it actually has a warning built right in.
Like, don't gamble with it.
Kind of. Users have to resist mistaking the model's probabilistic result, the range of outcomes, for deterministic predictions. Don't fall into the trap of thinking the model says X will happen. It helps you avoid the gambler's fallacy, that very trap it helps analyze.
Okay, so risk analysis, system exploration. What are the main ways it's used in Forex today?
There are three key applications, really. First, as we touched on, pricing complex derivatives and structured products. That was its original finance gig. It handles those tricky path-dependent options perfectly. It can also juggle multiple simultaneous uncertainties and how they relate to each other, their correlations.
Hmm.
Super useful when you're dealing with multiple currency pairs moving together or against each other.
So handling the really complex what-if scenarios for bespoke financial products. Okay, what about risk management? Where is the big benefit there?
Risk management. Monte Carlo is basically the bedrock of modern risk management practices. The big aha is that you can simulate thousands, even millions, of potential market scenarios. This lets you estimate key risk metrics like value at risk or VAR, answering questions like, okay, what's the most I could realistically lose, say, with 99% probability over the next 10 days?
Quantifying the downside.
Exactly. And also potential future exposure, PFE, for counterparty risk and for doing serious stress testing on portfolios, pushing them against extreme but still plausible market shocks. It's about sizing up your exposure to the unexpected.
And the third one for algorithmic trading. How does it help figure out if a strategy is genuinely good or just got lucky?
Right, algorithmic trading strategy validation. This is a really crucial and growing area. Here, it's not about predicting prices at all. Instead, it assesses the robustness of your strategy. The key insight here is using it to shuffle the historical trade outcomes from a backtest.
Shuffling the order.
Yes. By randomly reordering the sequence of your past trades thousands of times, you can see how much of your historical success was just down to a lucky run versus the strategy's actual edge. It helps distinguish skill from luck and gives a much more realistic picture of potential future drawdowns and returns. It answers that vital question. Okay, based on my past results, what's the probability my drawdown might actually hit, say, 30% next year? It's a serious reality check.
That's a huge shift, moving from what will happen to what's the range of possibilities, especially for risk.
Okay, let's peek under the hood. What's the core math making this work?
Well, at its absolute heart, Monte Carlo relies on a fundamental statistical idea, the law of large numbers. Basically, it says that as you increase the number of trials, or simulations in our case, the average result you get will get closer and closer to the true expected value. So by simulating thousands or millions of possible exchange rate paths, the average behavior across all those simulations gives us a pretty reliable picture of the system's underlying probabilities.
Like flipping a coin loads of times gets you closer to 50-50. Exactly like that. More simulations mean a more accurate picture of the probability distribution of future outcomes.
And to simulate those currency paths, you need a mathematical model for how they move. What's the workhorse model there? How should we think about it?
The most widely used starting point in finance for this is called geometric Brownian motion, or GBM. Intuitively, think of GBM as describing something like an exchange rate moving through time with two parts: a general direction or trend, which we call the drift, and a random shock or wiggle around that trend. It's also what's called a Markov process, meaning where it goes next only depends on where it is now, not its past path, which, kind of fits with the weak form of the efficient market hypothesis.
So it's got a trend and some randomness. Can you break down the equation a bit?
Sure. In simple terms, the equation looks like dSTTT plus sum blue AT. Let's unpack that. Sum blue is just the exchange rate at time. Sim-blue is the drift. That's the deterministic part, like the expected annual return or the underlying trend. The sigma is the volatility that represents the size of the random wiggles, basically the annual standard deviation of returns. Higher sigma means bigger random jumps. And DWT is the random bit, the Wiener process. Think of it as injecting pure unpredictable noise at every tiny time step.
Okay. Drift, volatility, and random noise.
Right. Now, using some math tools, specifically something called Ito's lemma, which helps handle randomness, we can find a solution for the future price sinking. What it tells us is that future prices depend on the starting price, adjusted by a factor that includes both the drift and that random shock. And crucially, this mathematical structure leads to future prices having a log normal distribution, which is good because it means prices can't go negative, a realistic feature for assets like currencies.
That makes sense. But okay, if volatility can be estimated from past price swings, what about the drift? That sounds like the really tricky part. How do you actually estimate that trend and link it to economics?
You've nailed one of the biggest practical headaches. Estimating volatility from historical data, like the standard deviation of daily returns, is relatively straightforward. But the drift, is unobservable. You can't just look at past prices and easily figure out the underlying trend going forward. It's notoriously hard to estimate reliably from history alone. And that's exactly where economic theory becomes essential. It gives us a framework, a justification for setting that up.
So how does economics help estimate the trend?
Well, a common approach, especially for pricing options in what's called a risk-neutral world, is using interest rate parity, or IRP. The theory basically says the expected change in the exchange rate should offset the difference in interest rates between two countries. So you can set M equal to domestic foreign.
Ah, using the interest rate differential.
Exactly. It gives you a forward-looking, theoretically grounded estimate for the drift, linking our statistical model directly to a core concept in international finance.
But hang on, what about other economic ideas, like purchasing power parity? Doesn't that suggest exchange rates should revert back to some fair value? That sounds different from a random walk with drift.
It absolutely can clash.
Yeah.
The basic GBM model assumes this random walk, but theories like purchasing power parity, PPP, suggest that real exchange rates should mean revert over the long run. To capture that kind of behavior, you'd use a different mathematical model, often the Ornstein-Uhlenbeck or OU process.
OU process.
Yeah. If GBM is like a random walk with a general direction, think of OU as being on a sort of elastic leash tied to an equilibrium point. The exchange rate still wiggles randomly, but it's constantly being pulled back towards that central value, often defined by PPP. It's a more advanced approach, better suited for long-term analysis where you believe economic forces pull things back into line. And you can even get more sophisticated in defining that equilibrium level. Instead of just PPP, you could use something like the behavioral equilibrium exchange rate, or BEER model.
Beer. Sounds tasty.
Yeah. It calculates an equilibrium exchange rate based on a wider set of economic fundamentals, things like terms of trade, net foreign assets, relative productivity. It's a richer economic story for that central anchor in an OU process.
So choosing GBM versus OU, it's not just math. It's about your view of how markets work. Short-term, random walk versus long-term mean reversion.
Precisely. It's a fundamental choice. GBM often aligns with the efficient market hypothesis view, good for short-term pricing options, where randomness dominates. OU, especially linked to PPP or BEER, reflects a belief in fundamental value and long-term anchors. There's no single right model that works for everything. The structure has to fit the question you're asking. A short-term trader might find GBM perfectly adequate, a long-term investor or a central bank analyst. They'd likely find GBM's lack of an economic anchor unrealistic and prefer an OU process where that drift term explicitly incorporates their economic view, acting as the bridge between the stats and the economics.
Fascinating. Okay, so we've seen its birth, why it's suited for Forex chaos, and the math engine with its economic links. But that engine needs fuel data. Let's talk about the reality check. Data quality and building a solid backtesting framework. How critical is the data?
Oh, absolutely critical. You hit the nail on the head. A quantitative model is, at the end of the day, only as good as the data you feed it. Garbage in, garbage out, as they say. Sourcing reliable data is step one. For broad macro analysis or long-term stuff, official sources are great. Think the European Central Bank, ECB, the IMF. They offer reliable, often free data. But if you're doing high-frequency trading or need tick-by-tick data, you pretty much have to go to commercial providers. Bloomberg, Reuters, TraderMate, they offer comprehensive, clean, low-latency data feeds, essential for serious work.
What about data straight from brokers, like ONDA or Ducascopy?
It's tempting because it's easy to get, but you need several key steps. First, data cleaning. That means dealing with missing values. Maybe you interpolate, maybe you fill forward or backward, and crucially, detecting and handling outliers, those weird spikes that can seriously mess up your statistics like volatility. Second, checking for stationarity. Many models assume the statistical properties of your data, like its mean and variance, don't change over time. You use tests like the augmented Dickey-Fuller or ADF test to check this assumption. Third, data transformation. It's very common in finance to convert prices into log returns. So the natural log of today's price divided by yesterday's price. Why? Because log returns often behave more nicely. Statistically, they tend to be more stationary and closer to a normal distribution, which fits models like GBM better. And finally, resampling. If you have daily data but your model works on weekly steps, you need to adjust the frequency appropriately.
Wow, so all those choices before you even run the model can really shape the outcome?
Massively. These pre-processing steps, they're effectively implicit assumptions of your model. Sometimes they have a bigger impact on the final results than whether you chose GBM or OU. If you build a model on raw, dirty data, you might get a backtest that looks amazing, but it's totally misleading. Robust validation must include checking how sensitive your results are to these pre-processing choices.
Right, okay. So data is cleaned and prepped. How do you then design a proper backtest to see if a strategy built on this model actually works and is robust?
Good question. For the actual backtesting, you've got options for software. Quant analysts might use flexible Python libraries like backtesting.py, Vector B, or maybe Zipline. Or you can use integrated platforms like MetaTrader's Strategy Tester, which is popular with retail traders. But the platform is just the tool. The design of the backtest is critical. You need a sufficiently long time horizon, maybe 10 years or more, to make sure your test covers different market conditions, bull markets, bear markets, sideways grinds. You also need a decent sample size of trades, ideally at least 200, 500, for the results to have some statistical meaning.
And that in-sample versus out-of-sample thing is key, right, to avoid fooling yourself.
Absolutely crucial.
Yeah.
You have to split your historical data. Part of it is the in-sample or training set. That's what you use to build or calibrate your model and strategy rules. The other part is the out-of-sample or testing set data the model hasn't seen during development. You use this to validate how the strategy really performs. If it only works well in sample, you've likely just overfitted the past data, and it won't work going forward. Walk-forward optimization is a more advanced way of doing this continuously.
And how do you measure success if Monte Carlo is forecasting price paths?
Right, if you're using Monte Carlo in that first way simulating price paths with GBM, then your backtest metrics are about accuracy. You'd use standard error measures like mean absolute error, MAE, or root mean square error, RMSE, to see how close your simulated price distributions were to the actual prices that occurred.
Okay, I think this is where we need that clarification again. Those two main uses of Monte Carlo in trading, can you quickly restate them? They seem easy to mix up.
Yes, it's a really important distinction. Let's be clear. Use case 1. Simulating price paths. This usually involves a model like GBM. The goal is to predict the distribution of future prices. Success is measured by accuracy against actual future prices, MAE, RMSE. Use case 2. Validating strategy robustness. This takes an existing backtest result from whatever strategy you have and assesses its risk profile by shuffling the sequence of those historical trades. It doesn't predict prices. Its output is a distribution of potential profit and loss, and critically, drawdown for that strategy. Helps separate luck from skill.
Okay, that makes it much clearer. Two distinct jobs. So let's say you've run thousands of simulations, maybe for risk analysis or path forecasting. How do you actually make sense of all that data? How do you visualize the chaos?
Visualization is absolutely key. It turns abstract numbers into something you can actually grasp intuitively. A really common one is the spaghetti chart of price paths.
Spaghetti chart?
Yeah, you plot maybe hundreds or thousands of those simulated price paths, all starting from the current price. It creates this kind of widening cone of uncertainty, showing the range of possibilities unfolding over time. Then you can overlay the actual price path afterwards to see how reality tracked against the simulated possibilities.
Gives you a feel for the potential spread. What else?
Another useful one is a histogram of the end period prices. So you take the final price from each of your, say, 10,000 simulations and plot how frequently different price levels occurred. This visually shows you the probability distribution of the price at that future point. For GBM, you'd typically expect to see a log normal shape. And when you're using Monte Carlo for strategy validation, the trade shuffling kind, plotting multiple potential equity curves, is incredibly powerful.
Seeing all the different ways your strategy could have played out.
Exactly. And from that collection of simulated equity curves, you can derive a histogram of the maximum drawdown. Seeing that distribution of potential drawdowns is often a real eye-opener for traders. Much more impactful than just looking at the single drawdown number from their one historical backtest. Seeing that spaghetti chart of 1,000 possible equity curves, it forces you to confront the real randomness rather than being lulled by history.
That sounds sobering but necessary. Do you also break down performance by market type? Like, how did it do in a bull market versus a sideways one?
Oh, definitely. Analyzing performance across different market regimes is crucial. A strategy might kill it in a trending market, but get chopped to pieces when things go sideways. So you first need to define those regimes. Could be qualitative bull, bear, range-bound, or quantitative, maybe using a volatility index like VIX, or a technical measure like average true range, ATR, to define high vol versus low vol periods. Then you segment your historical data based on these regimes and run your Monte Carlo simulations separately on each segment. This segmented analysis reveals what we call environmental dependencies. Does the strategy only work well under certain conditions?
Could you give an example?
Sure. Imagine a table showing the results. Maybe the average simulated PL is great in the bull regime, like 2016, 2017, the bear regime, like 2022, but negative in the sideways regime, say 2019. And perhaps the 95% confidence drawdown is much higher in the high volatility regime, like 2020. Seeing that tells you a lot about the strategy's robustness and where its weaknesses lie. It's key for risk management and might even lead you to build adaptive strategies that switch modes based on the current regime.
Okay, and when presenting these results, you mentioned confidence intervals. How does that help assess stability?
It's about moving away from single-point estimates.
Hmm.
Instead of saying the model predicts a 15% return, it's much more robust to state findings as confidence intervals. For instance, we are 95% confident that the future maximum drawdown will likely not exceed 30%. It gives you a probabilistic boundary for risk, acknowledging the uncertainty. And a really critical diagnostic is to compare your original historical backtest metrics to the distribution you get from the Monte Carlo simulations.
How so?
Let's say your original backtest showed a maximum drawdown of 10%. But when you run 10,000 Monte Carlo simulations by shuffling trades, you find that a 10% drawdown actually falls in the best 10% of all simulated outcomes.
Meaning it was likely lucky?
Highly likely, yes. It suggests your historical sequence of trades was unusually favorable. A prudent trader, seeing that, should realistically expect a much larger drawdown in the future, maybe closer to the median or even the 75th percentile of the simulated drawdowns, and should adjust their risk-taking and capital allocation accordingly. It manages expectations and helps prevent blowing up by betting too big on past luck.
That's a really practical way to use it, stress testing your own history. Can we walk through a more concrete example? Maybe building and testing a specific Forex strategy using Monte Carlo, perhaps showing it as an active tool for generating signals.
Absolutely. Let's consider building and testing a mean reversion strategy for, say, USD, using Monte Carlo simulations, not just for validation, but actively for signal generation. So for the model setup, we'd grab daily USD price data, maybe from the ECB, covering a decent period like 2010 to 2024. To get an idea of the underlying trend, we could use US and German 10-year government bond yields, perhaps from the IMF data portal. The core model we'll use here is still geometric Brownian motion, GBM.
Okay, so you have the price data and the interest rates. How do you plug those into the GBM parameters, the drift and volatility?
For parameter calibration, SQROs is just the current spot price of your USD at the time we run the simulation. For DIA, the drift, we'll use interest rate parity, IRP. So their U will be set to the US 10-year yield minus the German 10-year yield, RUSD, RUR. This gives us that forward-looking, theoretically justified trend. And for the volatility, we'll calculate it dynamically as the annualized standard deviation of the daily log returns over, say, the past 252 trading days using a one-year rolling window.
Right, so the model uses the current price, the interest rate difference for the trend, and recent historical volatility. How does this setup generate actual buy or sell signals day to day?
Okay, this is where it gets interesting. The simulation and signal generation process runs daily, maybe using Python. Each day, we run, let's say, 10,000 Monte Carlo simulations using our calibrated GBM model to project possible EURUSD paths for the next maybe 20 trading days, about a month ahead. Now, the dynamic signal logic, we compare the actual current EURUSD price to the distribution of simulated prices for that specific day. If the actual price is way above the simulated range, say above the 97th percentile of the simulated prices for that day, that's a sell signal. It suggests the price has moved statistically too far above its IRP-driven expected path, implying it might revert. Conversely, if the actual price is below the 5th percentile of the simulated prices, that's a BUY signal. Price is unusually low relative to the simulated possibilities.
That's clever. The entry signals are based on statistical deviations from the simulated cloud of possibilities. What about exits and stops?
For the exit signal, we close the position when the actual EURUSD price turns back towards the middle of the simulated distribution, say it crosses the 50th percentile, the median. For the stop loss SL, we can also set it dynamically based on the simulation's extremes. Maybe the SL for a sell trade is set at the 99th percentile of simulated prices, and for a buy trade at the 1st percentile. It's based on the simulated tail risk. The exit signal at the median effectively acts as our take profit, TP target. The key advantage here, as you can see, is that this creates dynamic trading bands. The 95th percentile level isn't fixed. It will naturally be wider when volatility is high and narrower when volatility is low. The strategy automatically adapts its entry and exit points to the current market conditions, which should make it more robust than using static indicator levels.
That adaptability is really neat. It lets the strategy breathe with the market's volatility. So how would you then assess if this dynamic strategy actually worked historically?
You'd run a backtest simulation. You could visualize the equity curve, how a hypothetical $100,000 account would have grown or shrunk, trading this strategy from, say, 2015 to 2024, using 2010-2014 data just for the initial volatility calibration. You'd compare this equity curve against a simple buy and hold USD benchmark. Then you calculate all the standard performance metrics. Compound annual growth rate, CAGR, the maximum drawdown experienced, the Sharpe ratio for risk-adjusted return, win-loss rate, number of trades, etc. And referencing that sample trade log we talked about earlier becomes really useful here. Seeing a table with specific dates, signals, entry-exit prices, stop losses, PL for individual trades, it makes the whole thing concrete and transparent, bridging the abstract simulation to actual trading decisions.
Fantastic illustration. It really shows Monte Carlo not just as a risk tool, but as an active part of a trading system. Okay, let's zoom out again. Based on everything we've discussed, what are the core strengths, the big advantages, and then equally important, the critical limitations we need to keep in mind?
Sure, the strengths are definitely compelling, and they explain why Monte Carlo is so embedded in quant finance. Its biggest advantage is probably its flexibility and ability to handle complexity. It shines when dealing with problems that are just too messy for neat analytical solutions, especially pricing those exotic, path-dependent derivatives, maybe with multiple underlying assets interacting. Second, it offers incredibly comprehensive risk analysis. It doesn't just give you one risk number, it generates the whole distribution of potential outcomes. That's invaluable for really understanding tail risk, calculating things like VAR and PFE, and rigorously stress testing strategies against a huge range of market scenarios. It's great for answering those what-if questions about potential losses. And third, that ability to detect hidden risk and backtest through trade shuffling is extremely powerful. It helps separate skill from luck by showing you the range of outcomes your strategy could have produced just by chance. Getting a realistic estimate of potential future drawdowns is crucial for managing capital and your own psychology as a trader.
Those are definitely strong points. Flexibility, deep risk insight, and a check on historical luck. But nothing's perfect. What are the big flashing warning signs, the limitations?
Absolutely. It's crucial to be aware of the downsides. First and foremost is its reliance on historical data and its underlying assumptions. The model fundamentally assumes the future will, statistically speaking, look like the past period used for calibration. It simply cannot predict true black swan events or structural breaks. Think a sudden pandemic, a major war, or a central bank completely changing its policy regime, things that fundamentally alter how the market behaves, breaking the patterns seen in the historical data. Second, the basic GBM model makes a strong assumption of constant parameters. It assumes drift and volatility stay the same throughout the simulation period. But we know in reality volatility clusters, periods of high vol followed by high vol, low by low, and drift can change with shifting economic fundamentals or policy. This simplification can lead to significant errors, especially over longer time horizons. More advanced models try to address this, but the basic version suffers from it. Then there's the practical issue of computational cost. Running tens or hundreds of thousands of simulations, especially for complex models or large portfolios, can take a lot of computing power and time. Cloud computing has made this easier, but it's still a factor. And often, the real bottleneck isn't the machine time, but the human expertise needed to build, calibrate, and correctly interpret these models. And of course, the golden rule, GI go, garbage in, garbage out. The quality of the output is entirely dependent on the quality of the inputs. If your parameter estimates, drift, volatility are poor, or your data is flawed, the simulation results will be meaningless no matter how many paths you run.
You also mentioned the fat tail problem earlier. Can you elaborate on that as a limitation?
Yes, that's a really fundamental, almost epistemological limitation, the fat tail problem. Monte Carlo is brilliant at exploring the world as defined by the model you give it, but it has no way of telling you if that model itself is fundamentally wrong about the nature of reality. For instance, standard GBM assumes returns follow a log-normal distribution, which looks like a classic bell curve when plotted logarithmically. But decades of research show that real-world financial returns often have fat tails.
Meaning extreme events happen more often.
Exactly. The tails of the actual distribution are much fatter than the normal bell curve suggests. Extreme positive or negative returns occur far more frequently in reality than a normal or log-normal model predicts. So if you run a GBM-based Monte Carlo simulation, it will systematically underestimate both the probability and the potential magnitude of these extreme tail events. A risk manager might feel comfortable with a 99% VAR calculated from the simulation, but the model's definition of that 1 in 100 bad event is likely far too optimistic compared to reality. This really underscores the need to sometimes use more complex models that can explicitly account for fat tails and jumps.
That's a huge caveat. The model explores its own assumptions, not necessarily reality's full range. Okay, so given these strengths and weaknesses, how does Monte Carlo stack up against more traditional economics-driven Forex models like PPP or beer? Do they serve different purposes?
That's a great point of comparison, and it highlights a really interesting trade-off in modeling. Let's quickly compare. You have purchasing power parity, PPP. This is the simplest idea. Exchange rate should adjust to equalize the price of a basket of goods across countries. It gives you a static fair value. Simple, intuitive, but famously bad at predicting exchange rates in the short to medium term. That's the PPP puzzle. Then you have models like the behavioral equilibrium exchange rate, BOR. These are more complex econometric models. They try to explain the real exchange rate using a broader set of economic fundamentals, net foreign assets, terms of trade, productivity differences, etc. They provide a richer economic story for why a currency might be misaligned.
But they have issues too.
Yes. Beer models can be prone to overfitting the historical data. Their estimated parameters can be unstable over time. And honestly, their actual out-of-sample forecasting power is often quite poor, despite telling a good story about the past. And then you have Monte Carlo simulation, based on stochastic processes like GBM or OU. As we've discussed, its main strengths are in risk analysis, pricing complex path-dependent options, and validating trading strategy robustness. It doesn't inherently provide a deep economic narrative unless you explicitly build economic factors into that drift term.
So there seems to be a trade-off here. More economic complexity doesn't always mean better prediction.
Exactly. That's a counterintuitive but really crucial finding in the field. There's often a significant trade-off between model complexity, or explanatory power, and actual forecasting power. Studies, like one by Canzorzi and others at the ECB back in 2020, have shown that complex fundamental models like beer, despite their rich economic narratives, don't consistently outperform much simpler models, sometimes even just PPP or a basic random walk when it comes to out-of-sample forecasting.
Why would that be?
Because the complex models, while great at explaining past movements with many variables, might be capturing noise or relationships that aren't stable going forward. They overfit. Simpler models like PPP, or even GBM's random walk, make fewer assumptions and can sometimes be more robust predictors precisely because they are simpler and less tailored to specific historical patterns. It highlights this tension between needing a model that tells a good story, explainability, and needing one that actually forecasts well. They aren't always the same thing, and analysts need to be aware of that. Simplicity can be a virtue in forecasting noisy systems like Forex.
Understanding that trade-off is key. Okay, looking forward, how can we make these Monte Carlo models even better? How can we push beyond the current limitations?
There are definitely avenues for improvement. One major area is advanced parameter calibration, moving beyond just using simple historical averages for drift and volatility. You can use more sophisticated econometric techniques like the generalized method of moments, GMM. GMM tries to find parameter values that make the statistical properties of the simulated data, like its mean, variance, skewness, best match the properties observed in the real historical data. An even more modern and powerful approach is Bayesian inference, often using Markov chain Monte Carlo (MCMC) techniques.
MCMC sounds complex.
It is, but the idea is powerful. Instead of trying to estimate a single best value for parameters like Mies and Vos, Bayesian methods treat these parameters themselves as uncertain. They have their own probability distributions. MCMC is a simulation technique used to figure out the likely range, the posterior distribution for these parameters given the observed data. You can think of it almost like running a Monte Carlo simulation within your Monte Carlo simulation. One level simulates the price paths, and the MCMC level simulates the uncertainty around the parameters driving those paths. It's really cutting edge for getting a handle on model uncertainty.
So getting smarter about the inputs. What about making the models themselves more dynamic and responsive to current market conditions?
That's the other huge frontier.
Yeah.
Building hybrid models that integrate alternative data in real time. The big weakness of traditional models is they mostly look backward. The future is about combining statistical rigor with live, often unstructured information. The key is making that drift coefficient dynamic, make it react.
How would you do that?
For example, you could integrate sentiment analysis, using natural language processing, NLP tools, to scan news feeds, like Reuters, Bloomberg, or even social media sentiment related to a currency pair. You can create real-time sentiment scores. We know sentiment drives short-term moves, so you could model the drift as, say, Mikol base plus X sentiment score it. The opoles might come from IRP, providing the fundamental anchor, but the sentiment score adds a dynamic, real-time adjustment based on market mood.
So the simulation reacts to news flow.
Exactly. Or you could integrate order flow and positioning data. Things like the commitment of traders, COT report, show net positions of large speculators and commercial hedgers. Access to proprietary bank order flow data gives even more timely insights into actual buy and sell pressure. If you see, for instance, a massive buildup in net speculative long positions, you could add a positive component to your EA, reflecting that underlying buying interest. By creating this kind of functional relationship where the drift of E at time is a function of IRP, but also sentiment at time t, and positioning at time t equal FIRP sentiment positioning, you move beyond simulating just a statistical process. You start simulating something closer to a behavioral process, reflecting how real market participants react to fundamentals, news, and positioning. That's where these models get really sophisticated and potentially move from being just risk tools to becoming more adaptive forecasting tools, blending theory, stats, and real-time intelligence.
What an incredible arc we've traced. From Monte Carlo's surprising origins in, of all places, nuclear physics, right through to becoming this absolutely indispensable tool in modern quantitative Forex analysis. It's so clear its real power isn't about giving us a single magic number for the future, but rather its unique ability to help us quantify and grapple with the inherent uncertainty, the chaos of the currency markets. By generating thousands, even millions of possible scenarios, it gives us this robust framework for pricing complex instruments, for managing portfolio risk, and maybe most importantly, for stress testing our own strategies against the market's fundamental randomness.
Indeed. But as we've emphasized, it's definitely not a silver bullet, is it? Its effectiveness hangs entirely on the quality of those underlying assumptions, the care taken in calibration, and the integrity of the data fed into it. A flawed model, even one run a million times, will still give flawed insights. The future, as we discussed, really seems to lie in developing those more sophisticated hybrid models, ones that integrate advanced calibration techniques like Bayesian methods with that flow of real-time alternative data, like market sentiment and order flow. That's where the next level of insight likely resides.
So, a final thought for you, our listeners. Now that you have a deeper understanding of how Monte Carlo simulation can be used to reveal the hidden risks, the range of possibilities, and even the behavioral undercurrents in financial markets, how might this change the way you evaluate information or perhaps even approach your own everyday decisions? How does acknowledging the pervasive role of randomness and the need for analysis that goes beyond just a single best guess influence your perspective? Something to ponder.